This guy in cargo shorts stole $8 billion, and almost everyone thought he was the good guy. And I mean everyone. Politicians, celebrities, the biggest names in finance. They all looked at this 30-year-old with the messy hair and the wrinkled t-shirt and thought, yeah, this is the trustworthy one. This is the guy we should hand billions of dollars to. So today we're going to break down exactly how Sam Bankman-Fried pulled off one of the biggest financial frauds in history, how he convinced the world he was a hero while quietly stealing from over 1 million people, and what the warning signs were that almost nobody caught in time. And I promise, even if you've never touched crypto in your life, you're going to understand every single piece of this. Let's start with the guy himself. Sam Bankman-Fried, or SBF as everyone called him, looked like the last person you'd expect to be running a multi-billion-dollar empire. Messy hair, cargo shorts. He famously slept on a beanbag at his office. He drove a beat-up Toyota Corolla even after he was worth tens of billions of dollars. And he talked constantly about giving his money away. He followed this philosophy called effective altruism, which is basically the idea that you should earn as much money as possible so you can donate it to causes that save the most lives. He said he was going to give away almost everything he made. He said profit was just a tool for doing good. And here's where Sketch, our resident suspicious stick figure detective, has something to say. Sketch is squinting hard right now. Because when someone's whole personality is, I'm one of the good guys, that's usually the first thing you should question. Not because good people don't exist, but because genuinely good people don't usually need to perform their goodness this loudly. The messy hair, the beanbag, the charity pledges, all of it was building an image. And that image was the disguise. But before we get to the fraud itself, you need to understand what FTX actually was, because if you don't know that, none of the rest makes sense. FTX was a cryptocurrency exchange. Think of it like a stock trading app. But instead of buying Apple or Tesla, you're buying Bitcoin or Ethereum or whatever other digital coins are out there. People would sign up, deposit real money, and use the platform to trade. And just like you trust your bank to hold your cash safely, FTX customers trusted that their deposits were sitting there, waiting for them whenever they wanted to take it back out. That's the key thing. The money was supposed to just sit there. Safe, untouched, ready to be withdrawn at any time. But here's where the story gets interesting, because FTX wasn't the only company SBF was running. He also secretly owned a separate company called Alameda Research. And Alameda was a trading firm, basically a hedge fund that placed big bets on the crypto market. Now, on the surface, having two companies isn't a crime. Lots of people run multiple businesses. But the problem here, the massive flashing red flag that Sketch is currently pointing at aggressively, is that these two companies were secretly connected in a way they were never supposed to be. FTX was holding customer money. Alameda was gambling with it. Here's the simplest way to think about it. Imagine you go to a party and hand your coat to the coat check. You get a little ticket, and you assume your coat is hanging safely on a rack in the back room. But what the coat check person is actually doing is renting your coat out to strangers while you're at the party. They're making money off your coat, and you have no idea. When you come back to get it, they just hope someone else's coat is available to give you instead. That's what FTX was doing. Customer deposits, real money that real people trusted were sitting safely in their accounts, were quietly being funneled over to Alameda. And Alameda was using that money to make risky trades, buy luxury real estate in the Bahamas, fund political donations to both parties, and prop up various parts of SBF's empire. The safe money wasn't safe at all. It was already gone. Now, Sketch wants to know, how did nobody notice this? And that's a fair question, because the answer involves one more layer of weirdness that makes this whole thing even more absurd. FTX had its own coin. They called it FTT. And this is where things go from shady to almost unbelievably brazen. FTT was a token that FTX basically printed out of thin air. They created it, they controlled it, and they held a huge amount of it themselves. And on paper, all those FTT tokens were worth billions of dollars, which made FTX and Alameda look incredibly wealthy and well-capitalized. Investors looked at the balance sheet and saw billions in assets and thought, great, this company is solid. But those billions in assets were mostly a coin that FTX invented and could manipulate the price of. It was like if you printed your own monopoly money, declared it was worth real dollars, and then used it as collateral to borrow actual money from real people. The whole empire was propped up by a token it created itself, and as long as the price of FTT stayed high, the illusion held. That's important, But what you really need to understand is what happened when that illusion cracked, because the collapse happened so fast it shocked everyone, even people who were already skeptical. It started in November 2022 with a leaked document. A crypto news outlet got hold of Alameda's balance sheet, and what it showed was alarming. A huge portion of Alameda's assets, the thing that was supposed to make the company financially healthy, was FTT, the made-up coin, the one FTX controlled. So the company that was supposed to be independently managing risk was actually just loaded up on funny money from its sister company. When that document went public, a man named Changpeng Zhao noticed it. CZ, as he's known, ran Binance, which was FTX's biggest competitor. And CZ announced publicly that he was selling all of his FTT holdings, which were worth hundreds of millions of dollars. He said it was a risk management decision. Whether it was a business move or a genuine concern, the effect was the same. It triggered a bank run. When people heard that the CEO of the biggest crypto exchange in the world was dumping FTT, they panicked. Everyone started trying to pull their money out of FTX at the same time. And that's when the problem became impossible to hide, because FTX didn't have the money. It had been sent to Alameda. It had been spent on real estate and political donations and risky bets that didn't pay off. The coat check had rented out everyone's coats, and they were never coming back. In the space of about a week, one of the most valuable companies in crypto completely collapsed. FTX filed for bankruptcy. Roughly $8 billion of customer money was just gone. Over 1 million people lost funds they had trusted to the platform. Some lost their life savings. SBF initially tried to play it off on Twitter, posting long threads about liquidity crunches and assets that were hard to move. He apologized a lot. He said he hadn't realized how bad things had gotten, but the story kept unraveling, and it became clear this wasn't a mistake or mismanagement. It was deliberate. The money had been flowing to Alameda for years. In December 2022, he was arrested in the Bahamas. He was extradited to the United States. And in late 2023, after a trial where former colleagues testified against him in detail, Sam Bankman-Fried was convicted on 7 counts of fraud and conspiracy. In March 2024, he was sentenced to 25 years in prison. The guy in the cargo shorts who said he wanted to save the world ended up stealing from over 1 million people to fund a lifestyle and a financial empire built on lies. So what do you actually take from this? Because this isn't just a crazy story about crypto. There are a few things here that apply to any investment, any platform, any situation where someone is asking you to trust them with your money. The first one is something the crypto community has been saying for years, and the FTX collapse proved it completely. Not your keys, not your coins. In crypto, if you leave your assets on an exchange, you don't actually own them. The exchange does. You own a promise. And as we just saw, promises can disappear overnight. If you can't see exactly where your money is and verify it yourself, you have to accept that someone else might be using it. The second thing is about image. SBF's whole persona, the humble genius, the charity guy, the guy who sleeps on a beanbag because he's too busy saving the world to care about comfort, that was a carefully constructed costume. And it worked brilliantly, because people want to believe in good guys. Charisma and a compelling story are not proof of honesty. They're often the thing that makes a fraud possible in the first place. Sketch has been keeping a list of red flags this whole time, and here's what's on it. A founder whose entire personality is being one of the good guys. A company secretly tied to another company that trades with customer money. A business that lists its own made-up coin as a major asset. And anyone who responds to hard questions with "trust me" instead of actual verifiable proof. If you see any of those things, you don't need to know everything about finance to know something is wrong. The wild part is that some people did notice. There were journalists and analysts who raised questions about Alameda and FTX's relationship years before the collapse. But SBF's reputation was so strong, and the bull market was so exciting, that most people dismissed the concerns. That's how these things work. The fraud isn't just in the math, it's in the social pressure to believe the story everyone else is believing. If you've made it this far, you went from knowing nothing about this story to understanding exactly how an $8 billion fraud was built, how it was hidden, and how it fell apart in a single week. That's not nothing. That's the kind of context that actually protects you. Now, Sketch wants to know which scam we should investigate next. Drop it in the comments, because there are a lot of them, and some are even wilder than this one. And if you don't want to get fooled by the next SBF, subscribing is probably a good move, because we're going to keep breaking these down until the scams run out. Which, unfortunately, is probably never.